Welcome to the Explainer. Right now, we are right in the middle of this massive, literal trillion-dollar debate that has completely gripped the financial world. We're living through an era of just unprecedented investment in artificial intelligence. It's this wild period where massive technological leaps are crashing headfirst into some seriously eye-watering valuations. But it really makes you wonder, right? Are we witnessing a totally sustainable economic revolution, or are we kind of teetering on the edge of a historic financial cliff?
Okay, let's just dive right into it. Are we in an AI bubble? It's the absolute biggest question keeping everyone from Silicon Valley coders to Wall Street asset managers up at night right now. Because as the initial hype of the 2020s starts to settle down, there's this pervasive anxiety creeping in. We're seeing a very distinct clash between the sci-fi promises of tomorrow and the cold, hard economic realities of today. To really wrap our heads around the scale of the skepticism out there, just consider this number. $700 billion. According to a recent Goldman Sachs report, that is the estimated amount of AI spending happening. And yet, crazily enough, it is currently yielding virtually zero measurable growth in US GDP. So the money is definitely moving and moving fast, but at a macro level, it's all flowing straight up the stack to infrastructure vendors, rather than actually spreading out and creating distributed economic productivity. So, here's our roadmap for today's explainer. First, we'll hit the trillion-dollar question of spending versus returns, followed by a look at the echoes of the dot-com era. Then, we'll map out the actual shape of the bubble, decode the circular money trap funding the whole thing, and explore when a correction might actually happen. Finally, we'll weigh the ultimate verdict: boom, bubble, or build-out. All right, let's start with part one, the trillion-dollar question of spending versus ROI. Right now, the burden of proof has totally flipped. We're looking at an environment where 40%, yeah, almost half, of AI projects are facing cancellation, mostly because of rushed deployments and weak infrastructure. What we're really watching here is a massive margin transfer. Regular enterprise IT budgets are basically being drained just to pay off a handful of giant infrastructure vendors. Meanwhile, the sheer physical costs are piling up. The International Energy Agency projects that data center electricity consumption could literally double by 2030. That is a staggering amount of power. And looking a bit further ahead, AI-related capital expenditure could hit an insane $1.6 trillion by 2031. The thing is, you simply cannot defend spending that you can't measure. And right now, a lot of IT budget owners are losing that exact argument. Moving on to part two, echoes of the dot-com era. Let's look at a historical comparison. Now, whenever tech markets reach historic highs fueled by some flashy new technology, comparisons to the late 90s are totally inevitable. Billionaire investors have explicitly been waving red flags, warning that today's AI landscape echoes the dot-com era's overvaluation of tech stocks. But actually, take a look at the sheer scale of market concentration today. At the absolute peak of the dot-com bubble back in 1999, the top 10 companies in the S&P 500 accounted for 27% of the total market cap. Fast forward to the current AI boom, fueled by those Magnificent Seven tech giants, and those top 10 companies now account for roughly 40% of the index's total market cap. So the concentration of wealth and really the concentration of expectations in just a few companies today is actually way more extreme than it was during the dot-com mania. Which brings us to part three, the shape of the bubble, or what we call the AI stack. See, recent academic research suggests we really can't view AI as one giant monolith. We have to look at it as a segmented ecosystem, an AI stack. Let's just walk up this stack together. Down at the solid base, we've got semiconductors. Companies down here are generating massive real-world revenues and enjoying incredibly high margins because, well, there's genuine physical scarcity and real demand for their chips. Now, in the middle, we have data centers and cloud platforms. This is where things start getting a bit riskier. It requires heavy capital expenditure, and notably, a lot of data center debt bonds right now are currently BBB rated or even junk rated. Finally, up at the top, we have agentic AI and applications. This layer is highly speculative. We're seeing startups with razor-thin margins and massive private market valuations, but very little actual monetization. So the bubble risk isn't really at the bottom. It's floating right up there at the top. So how does this actually translate into mathematical forecasting? Well, this right here is a log periodic power law, or LPPL model. Economists use this tool to spot what they call residual exuberance, basically irrational hype. Normally, there's a fundamental benchmark, which is what a company's price should be based on its actual cash flows and realistic expectations. But then you have a bubble-like price path. That's characterized by these accelerating, oscillating prices that just completely detach from the fundamentals. And analysts are increasingly spotting these exact explosive price dynamics in those top, highly speculative layers of the AI stack, completely driven by hype rather than real revenue. Let's look at part 4, the circular money trap. Is this whole thing a house of cards? Okay, so how exactly are these speculative top-layer companies getting such insane valuations without real consumer revenue? It's what market watchdogs are calling a circular money trap. Honestly, think of it like a financial snake eating its own tail. Big tech companies are pouring billions of dollars into emerging AI startups. Then, those startups turn right around and use that exact same funding to buy cloud computing space and chips back from the very big tech companies that just funded them. The big tech firms then turn around and report this as surging AI revenue. It's a totally closed loop. And meanwhile, to keep this whole engine running, venture-backed partners have amassed a reported $100 billion debt pile. If that circular demand ever stops, the revenue at the bottom could dry up instantly. All right, part 5. When will it pop? Let's talk about the triggers and catalysts. If this ecosystem is as fragile as some critics claim, what actually forces a reckoning? Market strategists note that crowds go from wisdom to madness when diverse opinions suddenly vanish and everybody's synchronizing on a single narrative. The trigger that shatters that narrative is almost always external. For example, aggressive interest rate hikes make borrowing for these massive capital expenditures way too expensive. Or a broader macroeconomic recession could instantly dry up the world's savings that are currently just looking for a home in tech stocks. Or, honestly, most simply, enterprise IT budgets might just hit total exhaustion. When companies flat out refuse to buy the downstream software because they haven't seen a return on investment, that whole circular debt structure just collapses. Finally, part 6. Boom, bubble, or build out. Let's bring this all together. So, how on earth do we make sense of these completely opposite views? Because for every expert screaming about an impending crash, there's a massive institution defending the rally. The crucial thing to remember is that both sides actually possess undeniable truths. The bubble case is super stark. We've got circular funding, extreme market concentration, delayed returns on investment, and heavy hitters like Jamie Dimon and the Bank of England warning that a lot of today's invested money is going to be wasted. But then look at the build-out case. Unlike the dot-com era where companies literally had zero revenue, today's AI chip makers are pulling in billions in realized cash flow. There's genuine, albeit early, enterprise adoption happening. The argument on this side is that these companies are generating actual growth, not just pure speculation. There was a really comprehensive academic study on this exact topic, and they landed on what I think is just a brilliant synthesis. They basically concluded that AI is best understood as a real technological revolution, but with localized bubble dynamics. So it's not pure fantasy, but it's also not some flawless productivity miracle either. It's a genuine leap forward. But just like the railroads or the early internet, the transformative nature of the tech itself doesn't magically prevent localized manias, overcapitalization, and severe financial crashes in the specific layers where the hype has completely outrun reality. Which leaves us with a pretty massive final thought. When you step back and look at the whole AI landscape, you really have to ask yourself, are your tech investments grounded in that solid base of realized revenue, or are they floating somewhere up in that highly leveraged, highly speculative top layer? Thank you so much for joining me for this explainer. I really hope this helps clear up some of the noise and brought the real data in focus. Catch you next time.